Welcome to this Market Masters special. Investors and traders are on their edge with tariffs from the US and the threats of tariffs. In addition, the US has reported high inflation and strong labor data. Does all this mean the US exceptionalism will continue? Will foreign funds continue to pull out of EMs like India? And when may the trend reverse now that the rupee and stock indexes have fallen quite a lot? For all these questions, I'm joined by Viktor Shvets, the global equity strategist at Macquarie, and by far one of the best veterans of emerging markets and indeed global markets. Mr. Shvets, thank you very much indeed for your time. I have a lot of tariff questions, but let me first start with this fund flow question. Since October, India has only seen funds moving out of India and other EMs into the US. How long will the US exceptionalism continue, you think?
Yes, I think if you think of large economies globally, very few can add labor capital and grow multi-factor productivity at the same time. United States is one of them. But another thing to remember, the reason United States is growing so fast, because public sector is aggressively de-saving. So in other words, United States is running primary deficits, not absolute primary deficits, of about 4% of GDP. You can compare it to, say, Germany, which is way under 1%, and the same applies to European Monetary Union. It's double the level of Japan. So it's a mixture of domestic productivity and a very significant de-saving in the public sector in the United States. So what US is doing is basically sucking the growth from all over the world into the United States.
Yeah, reciprocal tariffs are definitely upon us. That's very clear from the executive order. But will that continue to attract more money into the US markets?
Well, there are a couple of questions in there. Number one, why do you need tariffs? Do you try to implement tariffs in order to raise revenue, in order to pay for tax cuts? Are you doing it to level the playing field? Are you doing it to rearrange savings and de-savings? In other words, unless we trade with Martians, unless we trade with extraterrestrials, all savings in the world has to be equal to all investment. So if you try to rearrange it, then by definition, countries like China, Japan, Germany will have to consume a lot more, and the United States will have to save more and consume less. That actually could diminish exceptionalism. In other words, the growth potential, the growth, ongoing growth, not potential, will actually come down. So it's not totally clear what Donald Trump is trying to achieve, whether it's a negotiating tactic in order to get a slightly better deal for US corporates, whether it's beefing up and giving some meat to the base and ensure that the base feels that he is working very hard for American people, or whether it's a genuine desire to rearrange the pool of savings and investment and spending on a global basis. Remember, we can go back to Paul Walker and Bernanke when they were talking about surplus savings and how we need to rearrange the world. So those are the three very different answers. My view is that there is no particular consistency. He's trying to do all three. He's trying to make sure that the base is behind him. He's trying to bring something to the United States. He's trying to rearrange the world, but there are significant constraints. The biggest constraints he is facing is inflation in the United States, is Federal Reserve, as well as electoral outcomes. Because remember, within 12 months, we will be talking about midterms.
Okay, now to my more important point, what are your views on India? We've already seen steady outflows of funds. Now, at what point do you think India will look attractive to you?
I think my view has always been that investors are too bullish on India. In a sense, expectation of 7 to 8% GDP growth rates cannot be fulfilled by India as it stands today. If you want to get to 8%, either capital efficiency have to be a lot higher than what India is delivering, or you have to improve dramatically domestic productivity, including agriculture, or more importantly, public sector has to de-save a lot more. In other words, public sector deficits has to be running at a much, much higher level. However, having said that, if you think of India, again, it adds labor, it adds capital, it's gross multi-factor productivity, which somewhere around 5.5 to 6.5%, call it roughly 6, should be the optimum level at the current positioning. If you want to lift it another 100 or 200 basis points above that, as I said, you need to address those three buckets. Now, if we think of close to 6% real, that's about 9 to 10% nominal. That's more than double the nominal GDP that China, for example, is capable of delivering. And so at that level, you would say earnings per share in India probably need to be in low double digits. You probably should be looking at 11, 12, 13. The problem is expectations are much higher than that. You're really looking at expectations of 16, 18%. So the way I look at India, India is a case of growing into growth, which is in essence a much better problem than trying to extricate yourself from the liquidity trap that, for example, China have found itself in. So China to me is a safe harbor during a storm, but otherwise it has a very intractable problem. India might suffer during the storm, but essentially India have a circular capacity to continue to grow into the growth that India will be able to deliver.
Actually, Indian companies did have strong earnings growth until last year, running over 15%. Only this year has been slow, FY25. Do you see growth returning, earnings growth returning? Do you see India re-emerging as an attractive investment option sometime in calendar 2025?
No, I still think that earnings per share are too high. As I said, currently expectations are 18, even 19%. They really should be at least 500 basis points lower than what they currently are. And that's why I'm calling growing into growth. Now, when would India perform? Well, there are two things. Number one, certainly in the last 6 months, U.S. sucked in everything. So U.S. growth rates was exceptionally strong. As soon as there is a perception that the United States is becoming more volatile, in a sense that you don't really know what's going to happen, there is some degree of reversion back into other markets. Give an example. If Donald Trump is actually successful in freezing Russia-Ukraine conflict, if commodity prices will go down, especially energy, clearly people will be rotating into European monetary union. That's one of the easiest calls to make. The same applies to emerging markets. As they correct, you actually will have a rotation into emerging markets as well. So to me, it's very hard to predict whether that happens in a week or two or whether it happens in 3 months. To give an example, Europe, just in the last week, already outperformed the United States by 5%. That's a very significant move in what is only a few trading sessions.
Okay, let me come back to tariffs. Where does this tariff war stabilize? And who will be the winners and losers when things stabilize?
Right. Well, if you think of U.S. tariffs prior to Trump 1.0, they were roughly between 1% and 2%. Trump and Biden actually raised it to somewhere around 3 to 4%. My base case scenario remains that probably tariffs are going to roughly double. You could be looking at 8 to 10% average tariffs. Now, that will not pay for the tax cuts, coincidentally, because that will not generate any more than $1 trillion or maybe $1.5 trillion over 10 years, whereas a hole in the bucket is something like $15 trillion. So it will come nowhere near what is needed. But to go beyond that is creating a major problem, because if you only raise the tariffs, let's say to 8 to 10%, the incremental CPI impact in the US will only be maybe 20 bips, maybe 30 bips at most. Because remember, US is not a trade-dependent economy. It's broadly just domestic economy. But if you start going beyond that, if you start going to 15, 20%, this is when you'll be looking at 100 basis points at least high CPI. So the way I look at it, there is constraint on what Donald Trump can do, because the reality is 2 or 3% of the voters who switched to Donald Trump, because that was the magnitude really of the entire switch, did it for what I call 3 I's: inflation, inequalities, immigration. So he can't break those things because then electoral impact will be significant. So to me, there are still the guardrails. Now, there are other guardrails people are looking at, things like congressional and legislative, state and local level, corporate lobbying power, judicial. But the biggest guardrails, I think, are inflation rates as well as the Federal Reserve and what Federal Reserve is going to do going forward. Now, could he decide that the pain is necessary for a bigger picture? Possible. And I think that's what people are nervous about. But I think at the end of the day, he's pragmatic. And I think a more pragmatic answer will prevail. Who's going to be winners and losers? Essentially, if you are an ally of the United States in some form, and that includes Canada and Mexico, that includes Europe, that includes Australia, Japan, India. I think what allies need to do is to give something to Donald Trump, some degree of concession, so Donald Trump can declare a victory. I think positions of countries like China is very, very different. I think this is where it's going to be much stickier. It's going to last a lot longer. But for the allies, I think it's mostly negotiating tactic. And in a number of cases, it's going to get a little bit easier. When you have a conservative government coming in Canada, for example, when you have a right swing a little bit in Germany, for example, India already had India first policy for the last 10 years or longer. So intellectually or otherwise, Narendra Modi and Donald Trump are more or less in line. So whenever you are at that point, I think those countries are going to be fine. And I think the story is different for China, though.
Okay, Mr. Shvets, what are you expecting from the Federal Reserve this year by way of rate cuts?
Yeah, Fed is in a very difficult position because U.S. economy is so robust. As I said, primary reason it's robust is because public sector de-savings are incredibly high. Instead of thinking of public sector deficits, think of it as contributions that the United States government is making to people of the United States to raise their standard of living and to continue to grow faster. So they're still dealing with a very strong economy. At the same time, they might say, Victor, I agree with you. Donald Trump is not going to go crazy. There won't be any more than 8%. But you're not sure that that is not actually not going to happen. So as a policymaker, you have to be somewhat more constrained and concerned. However, if I'm right that there will be no massive deportations, that at best he's probably going to do extra couple of 100,000 deportations. Remember, the biggest deporter in U.S. modern history was Barack Obama. Trump, was only deporting half the number of people that Obama was. Biden is deporting this year, or was deporting last 24, the same level as Obama, one of the highest ever. Could Trump do a couple of 100,000 more? Yeah, probably. Could he restrict somewhat legal immigration? Maybe. But if you keep the net numbers, no more than 20-25% difference, there won't be an impact on 168 million labor market in the United States. So if Federal Reserve feels comfortable that there won't be massive shock on the labor market, if they're comfortable that there won't be massive shock on the tariff side, and if they're comfortable that there won't be massive shock from a fiscal pulse point of view. Because if you, in fact, curtail that fiscal pulse, the economy could crater very quickly. If they're convinced that that is not going to happen, then by the end of the year, they should starting again a cutting cycle. Because nominal GDP of the United States is down already from double digit to 4.9%. On a current path, it should be getting towards 4.5%, which means there is still some room to cut. My view remains neutral rates in the US are about 1% real. If you add inflationary break-even rates, you should be around 3.5%. Now, if you think of the market, 6 months ago, people were looking at 2.7 in January 26. Today, they're looking at 4.2, 4.3. To me, 4.2, 4.3 is too high. 2.7 is too low. You have to have something really horrible happening in the United States to get to that level. So somewhere around 3.5, I still think where Federal Reserve is probably likely to end up.
Okay, so one more cut possible. Would you expect dollar to remain strong for a better part of calendar 2025?
Well, actually, the way I looked at it when we previewed 2025, that US dollar will start higher, much higher, but then actually by the end of the year, it might start easing a lot. And the reason is if I resolve those uncertainties, if I reserve German election uncertainty, if I resolve the Japanese uncertainty, if I diminish the probability of extreme outcomes in the United States, if I diminish some of the geopolitical outcomes, and we can talk of Abraham's Accord in Middle East, we can talk of Russia-Ukraine freezing, then what you're going to find that US dollar could actually weaken. Now, I know it sounds ridiculous today when US dollar is so strong, but to assume that DXY will go to 115, 120, 125 is really to assume a massively dislocating scenarios on a global basis, which I think, despite all the noise, is probably unlikely.
Thank you, Viktor Shvets. It's always a pleasure listening to you. Thank you very much for joining us. Well, that's it on this edition of Market Masters. Thanks for watching.